Good. Well, thank you very much, Sean. Thank you, Stephanie, Constantine, Bloomberg, for hosting this. And let me add my congratulations to the students, the 50 students, and by extension, the several hundred students that are participating in this inaugural Scottish Economics Conference. Really applaud the initiative in creating this and their determination in pulling it off, and they are pulling it off. And my only regret, as Stephanie indicated, is that the beast from the east, Emageddon, are preventing me and Sean and undoubtedly a few others from attending in person. Although, you know, given the topic today, it's strangely appropriate to be joining them virtually. So I'm going to start off in talking about the future of money, start with the present of money. And if I were there, I'd be handing out 20-pound notes. I want to make that clear, because it's just part of how the Bank of England promotes the good of the people and the students. But this banknote is significant. It's significant because it honors Adam Smith, the great moral philosopher and hero of the Scottish Enlightenment. It's significant because it's a significant amount of money. If you're up in Edinburgh today, it's enough to buy you a beer and, well, a couple pints, actually. A couple pints and a burger at the Pear Tree Pub this evening. If you fancy a quieter but still highly stimulative night in, it will buy you copies both of The Wealth of Nations and The Theory of Moral Sentiments at Blackwell's. But it's significant, really, because without money, the decentralized exchange of Smith's invisible hand couldn't operate. Money unlocks the specialism of labor in the pin factory and the great increase in the quantity of work that results. And only money can solve the coincidence of wants between the butcher, the brewer, the baker, and the student on a Friday night. Now, many of those listening, and I believe watching at the university conference, probably don't see Adam Smith notes that often. And that's not just because you're impoverished students or because you live in Scotland, where you're more likely to encounter Sir Walter Scott or Nan Shepherd on a banknote when you do have cash. But it's because you probably use electronic forms of money, such as debit cards or electronic wallets on your phones for your everyday purchases, or go online for larger ones. And a number of you may hold other forms of money, electronic money, crypto or virtual currencies such as Bitcoin, Ether, or Scott coin. And a few may view paper money and even the Bank of England itself as archaic vestiges of an old centralized order of payments that will soon be swept away by a digital distributed future. And that's my topic for today, the future of money. Specifically, how developments in money and payments technologies could transform our economy in ways both good and bad, and how, for the good of the people of the UK, the Bank of England is helping to manage the potential risks and to realize the promise of the future of money. So let me start with a few definitions. In The Wealth of Nations, as I suspect, Sean, all of your students know, Adam Smith defines money by the roles it plays in society, in particular how well it serves as a store of value, as a medium of exchange, and a unit of account. And these functions operate in a hierarchy. There are many assets that people view as stores of value, houses, for instance. But those aren't necessarily used as media of exchange. By comparison, an asset can only act as a medium of exchange if at least two people are prepared to treat it as a store of value, at least temporarily. And for an asset to be considered a unit of account, it must be able to be used as a medium of exchange across a variety of transactions over time by several people. And this hierarchy points to the reality that money is a social convention. We accept that a token has value, whether it's made of metal or polymer or of code, because we expect that others will do so readily and easily. The tokens representing money have taken many forms over the millennia, from cowrie shells in ancient times to cigarettes during the Second World War to mobile phone minutes in modern Kenya. Most forms of money, past and present, have nominal values that far exceed their intrinsic ones, a gap that has meant that money has a long and sorry history of debasement, particularly private money that has inevitably succumbed to oversupply and eventual collapse. But Adam Smith worried also about the potential debasement of public money, and for good reason. Throughout history, governments would often betray the trust of their citizens, be it Henry VIII, reducing the precious metal content of his coins during the Tudor era, Pitt the Younger depleting the gold vaults of the Old Lady during the Regency period, or a pliant Reichsbank financing the government in Weimar Germany. With the wisdom born from such sad experience, most countries have now settled on centralized public fiat money, backed by robust institutions, in order to provide the public with money that's both highly trusted and easy to use. And most of the institutions that underpin sterling's effectiveness as money are now housed in the Bank of England. In particular, our commitment to the highest quality banknotes that you and the publican can use with confidence, the foundation of wholesale payments, RTGS, which processes over £600 billion per day to the highest standards of efficiency and reliability, the MPC, which conducts monetary policy independently to achieve price stability defined by the 2% inflation target, the PRC, which is charged with ensuring the safety and soundness of our banks and building societies that hold your money, the FPC, with its wide powers to maintain the resilience of the financial system as a whole, and finally, the powers and facilities that provide a wide range of liquidity to banks and other financial institutions in order to promote the continuous functioning of the system during shocks. The bank has been given clear remits by Parliament for these responsibilities, and it has operational independence, pardon me, and it has operational independence to achieve them. It's accountable to Parliament and the public for our performance. This robust institutional framework sets a very high bar for forms of money competing to dislodge sterling. But at present, there's more than 1,000 virtual or cryptocurrencies that are trying to do just that. In the depths of the global financial crisis, the coincidence of technological developments and collapsing confidence in banking systems sparked the cryptocurrency revolution. Its advocates claim that a decentralized cryptocurrency, such as Bitcoin, is more trustworthy than centralized fiat money because its supply is fixed and therefore immune from the age-old problem of debasement. Its use is free from risky private banks. It doesn't touch risky private banks. And thirdly, those who hold it can remain anonymous and therefore free from the ravenous eyes of tax authorities, or worse still, law enforcement. Some also argue that cryptocurrencies are more efficient than centralized fiat money because the underlying technology cuts out intermediaries like central banks and financial institutions and allows payments to be made directly between the payer and the payee. In a spirit of dystopian fear and libertarian optimism, the first or Genesis Bitcoin block was accompanied by the headlines from the Times, Chancellor on the brink of a second bailout for banks. So how well do cryptocurrencies fulfill the roles of money? The short answer is they're failing. Cryptocurrencies are poor stores of value. Over the past 5 years, the daily standard deviation of Bitcoin was 10 times that of sterling. Consider if you'd taken out a £1,000 student loan in Bitcoin last December to pay your sterling living costs for the next year. You'd be short about £500 right now. If you'd done the same last September, you'd be ahead by $2,000. It's quite a lottery. And Bitcoin is one of the more stable cryptocurrencies. This extreme volatility reflects that cryptocurrencies have neither intrinsic value nor external backing. Their worth rests on beliefs about their future supply and demand, ultimately about whether they'll be successful as money. Thus far, rather than a sober assessment of their future prospects, the prices of many cryptocurrencies have exhibited all the classic hallmarks of bubbles, including new paradigm justifications, broadening retail enthusiasm, and extrapolative price expectations reliant in part on finding the greater fool. And far from being strengths, the fixed supply rules of cryptocurrencies such as Bitcoin are serious deficiencies that would impart a deflationary bias on the economy. If those who cannot remember the past are condemned to repeat it, recreating a virtual global gold standard would be a criminal act of monetary amnesia. The most fundamental reason to be skeptical about the longer-term value of cryptocurrencies is that it isn't clear they'll ever become effective medium of exchange. Currently, no major high street or online retailer accepts Bitcoin as payment in the UK, and only a handful of the top 500 US online retailers do. For those who can find someone willing to accept in cryptocurrencies, the speed and cost of the transaction is generally slower and more expensive than payments in sterling. And that's because the more heavily used cryptocurrencies face severe capacity constraints compared with other payment systems. For example, Visa can process up to 65,000 transactions per second against just 7 for Bitcoin. If you use a debit or credit card in the UK, the transaction's completed in seconds and without exchange rate risk. In contrast, Bitcoin users face queues of hours, and those waiting to get to the front to make time-pressing payments, for last orders, for example, need to offer up a transaction fee sufficiently large to persuade Bitcoin miners who verify and process the transaction to do so quickly. These fees, the fees that are paid, vary through time. They reached £40 in late last year. They're currently around £2, but even that's expensive relative to cash, cards, or online payments, which cost the retailer around 1.5 pence, 8 pence, and 19 pence, respectively. So even at its low volumes, the costs of Bitcoin mining are enormous. Its current annual electricity consumption is double that of Scotland. In comparison, the global Visa network's energy use is less than 1/2 of 1% of that of Bitcoin, despite processing 9,000 times more transactions. So given their poor stores of value and inefficient and unreliable media of exchange, it isn't surprising that there's little evidence of cryptocurrencies being used as units of account. There are the few retailers that quote in Bitcoin in Britain update at a very high frequency in order to maintain stable prices in traditional currencies such as sterling. And the bank isn't aware of any business that accepts Bitcoins in payments that also maintains its accounts in Bitcoin. Now, even though the prospects of replacing fiat money are tenuous at best, cryptocurrencies are of growing interest to policymakers, many of whom prefer the term crypto assets expressly because they aren't true currencies, and I'll adopt that convention for the rest of my remarks. Crypto assets raise a host of issues around consumer and investor protection, market integrity, money laundering, terrorism financing, tax evasion, and the circumvention of capital controls and international sanctions. The bank's Financial Policy Committee is currently considering the risks posed to UK financial stability, and internationally, the Financial Stability Board will report to the G20 in Argentina later this month on the same topic globally. At present, in my view, crypto assets do not pose material risks to financial stability. In part, this is because they're small relative to the financial system. Even at their recent peak, their combined global market capitalization was less than 1% of global GDP. In comparison, at the height of the dot-com mania, the valuation of technology stocks were 1/3 of global GDP. Now, authorities are rightly concerned that given their inefficiency and anonymity, one of the main reasons for the use of crypto assets is to shield illicit activities. This cannot be condoned. Anarchy may reign on the dark web, but in the UK it's just a song that your parents used to listen to. Moreover, parents like me, once trying to be cool. Moreover, structural vulnerabilities in cryptocurrencies mean that they're inherently risky, with extreme price volatility and poor market liquidity due to fragmented markets and highly concentrated holdings, which in turn facilitate manipulation and misconduct. These vulnerabilities are compounded by operational and technological weaknesses, as evidenced by a series of major crypto asset heists. In addition, there's unease that the combination of these vulnerabilities and widening retail participation could damage the reputations of those financial institutions connected to crypto asset markets, and in extreme circumstances, even undermine confidence in the financial system itself. So authorities need to make some decisions. They need to decide whether to isolate, to regulate, or to integrate crypto assets into the financial system. A few jurisdictions have banned them outright, and some, most prominently China, have sealed them off from the core of their financial system. If widely adopted, however, isolation risks foregoing potentially major opportunities from the development of the underlying technologies. A better path, I'd suggest, would be to regulate elements of the cryptocurrency ecosystem to combat those illicit activities, promote market integrity, and protect the safety and soundness of the financial system. Indeed, the time has come to hold the crypto asset ecosystem to the same standards as the rest of the financial system. Being part of the financial system brings enormous privileges, but also great responsibilities. And in this spirit, the EU and the US are requiring crypto asset exchanges to meet the same anti-money laundering standards and counterterrorism standards as other financial institutions. And conduct and market regulators are considering how to classify crypto assets in order to determine the appropriate level and type of investor protections. In my view, holding crypto asset exchanges to the same rigorous standards as those that trade securities would address a major underlap in the regulatory approach. And as the SEC and here in the UK, the FCA have argued forcefully, so-called initial coin offerings will not be allowed to use semantics to avoid securities laws designed to protect investors, retail investors in particular. Finally, prudential regulators like the bank's PRC are in the process of clarifying how the existing regulatory requirements for banks, including capital, apply to any future crypto asset exposures. So, I trust you may have got a bit of the drift by now, gathered by now, that for many reasons, in my view, the crypto assets in your digital wallets are unlikely to be the future of money. But that isn't meant to dismiss them. Their core technology is already having a major impact, and bringing crypto assets into the regulatory tent could potentially catalyze innovations to better serve the public. Indeed, crypto assets help point the way to the future of money in three respects. First, by suggesting how money and payments will need to adjust to society's changing preferences. Secondly, through the possibilities their underlying technologies offer to transform the efficiency, reliability, and flexibility of payments. And thirdly, by the questions they raise about whether central banks should provide a central bank digital currency accessible to all. And I want to take these in turn. First, crypto assets are part of a broader reorganization of the economy and society into a series of distributed peer-to-peer connections across powerful networks. People are increasingly forming connections directly, instantaneously, and openly, and this is revolutionizing how we consume, work, and communicate. Yet the financial system continues to be organized largely around a series of hubs like banks, payments, clearings, and settlement systems. And crypto assets are an attempt to create the financial architecture for peer-to-peer transactions. So even if the current vintage isn't the final answer, it is throwing down the gauntlet to the existing payment system. And these existing systems must evolve to meet the demands of fully reliable, real-time distributed transactions. The second challenge of crypto assets is their underlying technology, obviously particularly distributed ledger, which can do many things. It can increase the efficiency of managing data, improve the resilience by eliminating central points of failure, enhance the transparency and auditability of transactions, and expand the use of straight-through processing, including with smart contracts that automatically update and, if appropriate, pay. These properties mean that distributed ledger technology could transform everything from how people manage their interactions with public institutions to how businesses manage their supply chains. Now, the third challenge is that crypto assets raise the obvious question about whether their infrastructure could be combined with the trust inherent in existing fiat currencies to create a central bank digital currency, or CBDC. Now, currently, only banks can hold electronic central bank money. To be truly transformative, a general purpose CBDC would have to open access to everyone. And the Bank of England has an open mind about the development of a CBDC and an active research program dedicated to it. That said, given the technological shortcomings in distributed ledger technologies at present, and the risk with offering central bank accounts for all, a truly widely available and reliable CBDC does not appear to be a near-term prospect. Moreover, its desirability depends on the answers to a series of big policy questions. And while these are largely for another speech, you'll be happy to know, I would note that a general-purpose CBDC could mean a much greater role for central banks as part of the financial system, a role that could potentially mean central banks disintermediating commercial banks in normal times and running the risk of destabilizing flights to quality during times of stress. And there are also broader societal questions, such as how society balances privacy rights with the extent to which the information that would be contained in a CBDC could be used to fight terrorism and economic crime. A general-purpose CBDC shouldn't be a solution in search of a problem or an effort of central banks to be down with the kids, especially because there are more immediate ways to give you what you want. So while our research on a possible future CBDC will continue, we're more excited at the Bank of England about the opportunities to transform digital payments now. In particular, the combination of the bank's overhaul of RTGS, that big central payment system, and new technologies promise payment systems that can better serve society's demands for fully reliable, real-time, and distributed peer-to-peer transactions. Now, RTGS is already pretty awesome, but it's also the same age as most of the students watching this, so we're in the process of renewing it. And this could mean more than you might think. Currently, when you pay for your burger and pint at the pub, or your books at Blackwell's, you probably use a debit card, a credit card, or the wallet in your phone. But all of these need to be routed through the card provider's network. Over the past 4 years, the payment-related costs that your publican or bookseller pay and ultimately pass on to you has come down by about 40% to about a P per transaction. Well, these are small and, as I said earlier, much better than Bitcoin. They remain non-negligible, and that's partly because there's relatively limited scope for them to be competed away by innovators due to restricted access to the UK's major bank-to-bank payment system known as faster payments. Now, the good news is that non-bank payment providers, PSPs, can now access RTGS, and we expect the first of them to do so directly this spring to help drive costs down and service up. So what can that mean? Well, innovative PSPs can deliver a world where you can split around in the pub electronically and instantaneously, needing nothing more from your friends than a QR code on their phone or their mobile number. By doing so, electronic money is effectively becoming much more like its physical relative, allowing genuine, immediate peer-to-peer transactions without the need for a middleman. Our overhaul of RTGS is helping to reduce complexity and costs in other areas, such as cross-border payments, where the bank is leading the efforts of other central banks and the private sector to use central bank money in cross-border payments through synchronized RTGS systems. When coupled with capture of richer payments data that will be made possible by the renewal of RTGS, the system will also help support innovative services for the more effective management of personal and company finances, benefits that will be amplified by the application of open banking. Finally, at the wholesale payments end, the bank believes that the distributed ledger technology could potentially save tens of billions of pounds of capital, currently tied up in settlement, while settlement completes. And while the best of the private sector are working hard to find ways to unlock this value, that tens of billions of capital, the bank is building the new RTGS so that forms of security settlement, including those that use distributed ledger technology, will be able to plug in directly. So let me conclude. So, while Adam Smith was famously cautious about the role of the state, he recognized that it should furnish the rules and conditions within which private innovation can flourish. In the monetary sphere, this means providing money which citizens can use with confidence and ease. And the Bank of England delivers just that. From the quality of our banknotes to the stability of our inflation, the resilience of our financial system, and the efficiency and reliability of our core payment system. As we do so, we're overhauling that core payment system, RTGS, so that private innovation can flourish. And by bringing crypto assets onto a level regulatory playing field, we can help catalyze a more resilient, effective, and innovative payment system. With all of these foundations in place, the scene is set for better payments, a better economy, and a better Friday night out. So with that, I will thank you, and Stephanie's going to join me. Yes.
Yes.
Thank you very much.
I'm going to moderate some